Hi, this is Aaron Andrew with Missed Fortune. What we want to go over now is go over the variable loan. So we're going to talk about how we access our money tax-free out of a life insurance contract using the variable loan method. Again, I want to refresh your memory. This is found in section 7702 of the Internal Revenue Code that allows us to access our money tax-free out of an insurance contract by borrowing against the cash value. So once again, let's use an example of having $100,000 of cash value inside the insurance policy. You don't want to just withdraw the money or surrender the policy and take all the money out because you're going to owe taxes on the growth. We want to keep the insurance policy in force until the day you pass away to allow it to still be tax-free under Section 101 with the death benefit. So what we're going to do is go over this powerful example of using what's called the variable loan. So with the variable loan, here's how it works. You have $100,000 of cash value, and that $100,000 is earning anywhere between, let's say, 0% up to, let's say, 15% with some companies. This is an indexed universal life policy, so every year you're guaranteed not to lose. You can earn as low as 0, usually tied to an index like the S&P 500, or some of them have other indexes. And you can earn as high as 15, as low as 0, and that's going to average, historically, is about an 8% return. So we're going to say this cash value is earning an average of 8. For example, 2008, you made 0 because the market tanked like a negative 40. 2009, the S&P went up a good amount, and so it went above the cap of 15%, so you made 15% that year. But you didn't lose anything in 08. You made 15 last year, so average the last 20, 30 years is about 8% or higher in most companies that have a 0 to 15 strategy. So let's go over how this works now with the variable loan. So to access the money tax-free using the variable loan method is your $100,000 is earning an average of 8. We go to take out a $10,000 loan. And what happens to your cash value is your $100,000, there is a lien against this. Let's just say, let me put this up here first. You got $10,000 that is earmarked to pay off that loan. And you've got $90,000 net. So let me back up here and say, if you have a bank account that has $100,000 in it, and you want to take out 10 grand, you now have $90,000 left, right? That's exactly what I'm trying to show here, is that you take a loan against it, you still have your $100,000 in there, but you have a lien against it of 10 grand, so you have a net of 90. 10,000 of your cash value is earmarked to pay off the loan. Just like if you owned real estate and you have a property worth $100,000 and it's free and clear, well, you want to take money out of that property, but you don't want to sell the property and have to pay taxes if it's an investment property, as an example. So we just want to borrow against it. We borrowed $10,000 against that property. You have $90,000 net equity in that property now, right? Same thing with a life insurance contract. It's a good example to show that you have $100,000, but you have a lien against it of 10, so you have a net of $90,000 of cash value. So with the variable loan, they're going to charge you a rate that is tied to the Moody's corporate bond yield average, and that's been around since 1919. Currently, it's roughly about 6%. So let's just say we borrow $10,000 and we're being charged 6. And that rate can change once a year or once a month with some, but that rate is tied to, again, a bond rate that is variable. It's going to change. Now, let's say it's 6%. Well, what happens with our cash value over here? Well, our cash value earns whatever the index does between 0 and 15. So let's say it's 8%. Okay, what I'm going to do here, just to keep this simple, say 8% here, 8% here. Now, if you haven't watched the fixed loan video, I want to make sure that you watch the fixed loan video because all policies that have a variable loan offer the fixed loan. So make sure that you understand how a fixed loan works, where when you borrow $10,000, you are charged like 6%. Then this $10,000 of your cash value earns 6, so it's a wash. That's the traditional loan or the fixed loan. That's the conservative approach. The variable loan might be a little bit more aggressive, but it can be in a huge advantage for you cash flow-wise. So you borrow $10,000 here, borrowing at 6 right now. This $10,000 doesn't earn the same rate. It stays in the indexed account earning the same rate of 8%. So if you earned 8% on your cash value, you borrowed at 6, you made a 2% spread on your money. So let's just use that example down here and say, well, 1 year later, this loan balance is $10,600. That's your loan balance. Your cash value over here, $90,000, is now at $97,200. And $10,000 over here is at $10,800. Now you can just add those two together. That's your total cash value. Then you have this lien against it of $10,600. But I wanted to isolate exactly $10,000 of your cash value that's there for the loan, just to show that you made a spread of $200 between those two. As you start to borrow more money from the insurance contract, if you constantly make a 2% spread, 1% spread, or sometimes you make the 15% cap and you borrow down here at 6 and you make that 9% spread, that could be huge for you in extra cash flow that you can take out of the insurance contract. Now, what's the downsides? Well, with the variable loan, you could also, like you did in 2008, you borrowed and this money earns 0. So all your money earns 0%. You were still charged 6. So it was a negative $600 in cash flow. You didn't actually have to pay that $600. Your loan balance, you just have a higher loan balance, $10,600, and your cash value didn't go up at all. So some years it's going to be that way, but historically speaking, the Moody's corporate bond yield since 1919 till current has averaged about 6%. So if we are borrowing at about 6% on average over on the loan side, and that rate doesn't change very often, a bond rate is going to move very slowly, which you can look up the Moody's corporate bond yield. It has moved very slowly. So it's not like it's going to jump up to 10% one year and then another year be 5%. And your cash value, though, is going to fluctuate a little bit more in return between the 0 and the 15. So some years, we're going to earn 0. Some years, 15. We're going to average about 8. So if you earn 8 over here, you borrow at 6 on this side, well, you're going to earn a 2% spread. That allows you to take out a lot more income from the policy. Because over time, that spread becomes really big in how much you have in cash value, how much you have in loans, and that spread on that money. We're just using $10,000 right now as an example. Now, since 1950 till current, the Moody's corporate bond yield has averaged more like 7. So 7 versus 8, a 1% spread. In the 80s, the Moody's corporate bond yield was pretty high because interest rates were high. So in that example, it might be more of a negative spread depending upon what the policy earns. But then again, the policy was earning really high as well because interest rates are relative. So the variable loan can be a huge advantage for you. And the nice thing is a lot of companies allow you to switch between the variable loan to the fixed loan. So if you have the variable loan and you're going along borrowing at 5 or 6% because this rate's really low and your cash value is averaging 8, you're making a nice spread. All of a sudden the market gets a little shaky and the interest rate might be a little bit higher for one reason or another. Then you can switch to the fixed loan, like we showed in the other video, that can be more conservative. And so some companies allow you to switch between the two loans. Others, you have to pay off the loan balance to be able to switch. But yes, the variable loan is a huge advantage. So make sure, if you want to see an illustration with that you have us show you a fixed loan example and a variable loan example so you can see the difference in income and what we borrow at here on the variable loan. We can change that to show you what it would be in different situations. And that is the variable loan. So thank you very much, and we'll end it there.